to the monthly roundup from Kepler Trust Intelligence, brought to you in association with Schroders. Join me, Ryan and David as we discuss the most interesting news and hot topics for investors from the last month.
And in this month's edition, David goes all emerging markets with updates on an AWEM video.
Jo will talk us through the highlights of her podcast with SEQI's Randall Sandstrom and Baillie Gifford's Lucy Maestrova.
But first, Ryan will run us through the news, including some interesting potential changes to corporate strategy to a particularly well-known manager.
Yes, all of that to come, but first we begin with the news of a proposed combination between BlackRock Throgmorton, or THRG, and BlackRock UK Smaller Companies, or BRSC, which, if approved by shareholders, will create the largest growth-orientated trust in the 20-plus AIC UK Smaller Companies sector.
So this sounds like one of the more logical deals that we've seen proposed in recent months. Are we expecting any changes as a result of this?
Well, whilst the two vehicles do have a very similar approach, there are some differences in how they go about things. So, for example, Dan Whitestone, the Throgmorton manager, has the ability to short stocks, i.e. profit from falling prices, although despite this, there is still around 75% overlap between the two portfolios. Now, this is one of the features that's not being carried over, the shorting ability, as it will predominantly be the BRSC approach and name that will influence the combined vehicle, with BRSC's manager, Roland Arnold, becoming the lead manager of the combined vehicle and Dan becoming co-manager. There's also a slightly interesting quirk of Throgmorton's dividends as well, which were recently announced in their full year results, which will be available on the KTI website shortly. There was a second interim dividend in lieu of the final dividend of around 15p, plus the board have brought forward the interim dividend of next year, so the financial year to November 2026. Now that's going to come in before the deal is proposed, of around 5p. So meaning investors going in today could effectively get a 3% yield from their investment over just the next couple of months. Although I should note that this is likely factored into the price already, but something worth noting for income-focused investors.
So a potentially interesting near-term opportunity there, but are there any new longer-term measures being introduced as part of this?
Yeah, absolutely. There have been several tweaks for shareholders to be aware of. So firstly, there are some changes to charges. BlackRock are using the opportunity to lower the management fee, including tweaks to their tiered approach. They're also dropping THRG's performance fee and also undertaking a 6-month fee waiver to make it more competitive. And as such, the combined trust will have one of the most cost competitive charging structures in the peer group. Furthermore, there are also some tender offers being introduced. So Throgmorton shareholders will be able to tender up to 38% at close to NAV ahead of the combination. BRSC is being offered at up to 28% of their shareholding close to NAV. And then with the combined vehicle, there'll be the introduction of a 3-year conditional tender offer of up to 100% starting in 2028.
And dare I say it, what about the thorny issue of Saba?
Yeah, absolutely. So as a quick reminder, Saba are on the register of both trusts, but have agreed to take no action until 2027. This, we understand, has been extended till around 2030, although there are, of course, opportunities for Saba to relieve their capital at close to NAV for their activism in the interim because of those tender offers.
So thank you for that overview. And now elsewhere in the news, we saw European Opportunities Trust start a strategic review. So what's going on there?
Yeah, an interesting turn of events for one of the more well-known investment trust managers, Alexander Darwell. After a series of challenges for the trust over a prolonged period, including some activism on the register, the failure of Wirecard, which is a large holding, and a couple of changes to the manager's investment company, the board is now formally considering options for its future, and it's unlikely to meet the conditions of its tender offer.
So getting ahead of that continuation vote then, what could those options be?
Well, there are a few options on the table, including a potential merger with a peer. And I assume that by announcing this, they're expecting someone to come forward. There is also the option for a straight up cash exit. However, there's also a third option, which is to roll into an open-ended fund at River Global. And now they recently became Alexander firm Devon Equities parent company, which itself began life when Alexander left Jupiter in 2019, although he kept management of the trust EOT. Now, with the River deal being relatively new and Alexander having a fairly loyal set of shareholders due to some very good long-term performance prior to this sort of nearer term challenging period, this option is possibly one of the more unlikely outcomes.
And of course, we will bring you updates as we hear them. Now, Ryan, before we wrap up on the news, do you have a quick update on the Saba saga?
Oh, of course we do. Not a month goes by without some news from Saba. So as a quick reminder, last month we mentioned 2 votes with Herald and Impax Environmental Markets that sought to bring their own Saba situations to a head. And we've had some interesting developments with the latter of these.
Yeah, so I believe there was a very interesting public letter from the chairman.
Quite right. Really interesting insights of what's going on behind closed doors in negotiations with Saba's Bose Weinstein. Now, IEM's chairman has effectively outed the strategy of Bose, which is to create a vehicle to target discounted trusts and either consolidate the assets together by taking over or to force actions into narrowing the discounts and gain from that share price momentum. Now, this was pretty much what the industry was expecting from this, and considering the way Saba went about things. But it's interesting to have it confirmed by a senior board member who has been in direct negotiations with Bose and perhaps gives us more of an understanding on why he's got such ongoing antagonistic approach to the likes of Edinburgh Worldwide. Now, I will just say that the whole situation is a very moving picture. Counter statements were published sort of just before we went to recording. So we will, of course, bring further updates as we get them.
Indeed. Now, moving on to results, David, you have some much anticipated UK Wind results.
Yeah, no, UK Wind is one of the more popular trusts on KTI, I think, Greencoat UK Wind, to give it its full name. Now, that's not surprising, given we were just talking before the podcast, actually, that the yield is now kind of verging on 11%, which is obviously very attractive. We'll touch on that dividend later on, but we'll very quickly get the bad news out of the way first, which is probably well known. Net asset value decreased by 11.8% over 2025, with lower power price forecasts driven by falling gas prices having the most significant impact on this. In addition, low wind, which obviously is something that Greencoat itself can't particularly control, particularly that happened in H1, meant that portfolio electricity generation was 8.5% below budget.
Yeah, some bad news for Greencoat in there, although we should note that gas prices have been spiking over the last few days for what we'll call as geopolitical tensions, and then leave it at that. Anyway, moving on to some better news for Greencoat. What is the sort of good news that we can take away from the results?
Yes, there were definitely some positives, particularly with the dividend. Like I said, once again, that increased in line with inflation, and dividend cover carries on kind of looking strong. Now, we've mentioned the backdrop to things a little bit, this renewables consultation. We've talked about that. That's now out the way. It's kind of provided some clarity on the backdrop, and hopefully Greencoat can kind of start looking forward, which we're going to do now. Now, support for renewable energy does remain strong within the UK government at the moment, and UKW looks to be in a good position. It said that illustrative average dividend cover over the next 5 years will be about 1.8 times, which, like I said before, is pretty strong. I think one good thing that kind of resonated with me is that while management remains committed to disposals and using those proceeds that it makes from them to reduce debt and to buy back shares in the short term, they did start talking about the longer term future of the trust. Now, that's kind of predicated, obviously, on using some of this capital for reinvestment, reinvesting back into the company, the assets that it owns, the wind farms. So hopefully, at some point in the future, they can kind of get back to that, and hopefully there'll be some positive signals for the future of the trust.
And for full clarity, I should say that Greencoat UK Wind is actually one of my ISA picks for the year in our recent publication we did. And I know I should be in my capital appreciation phase of my investment career, but I think that yield is just so extreme. It's really worth sort of picking up to and trying to get that as a bit of a total return.
Yeah, I think that's already been in my SIP for quite a while. So I'm hoping you're right at some point.
I'm feeling slightly left out now. Sticking with a similar theme, Ryan, you looked over our results piece on BlackRock Energy and Resource Income.
Indeed, yep. So BERI, as per the ticker, released its full year results to the year end 30th of November 2025. In these results, they saw a third straight year of outperformance over its bespoke benchmark, made up of a mixture between mining, energy, and clean energy. The trust itself saw a 24% NAV return versus 18% for the key comparator.
So pretty good at the headline level. What's driven these results?
Well, interestingly, some of the better contributors have come from the more illiquid holdings, demonstrating the benefits of the investment trust structure. And the flexibility to move between their three investment areas of traditional energy, mining, and energy transition has allowed the managers to exercise their stock selection expertise and drive performance.
And what about the outlook moving forward?
Well, there are a number of promising themes emerging that have the potential to influence future performance, not least of all the ongoing AI data center build-out, which will have implications for both energy prices, as well as the mining required to provide all the materials for such a build-out. As such, the outlook is looking very supportive, with BERI's flexibility very well placed to capture it.
And that brings us to the end of the results and a slight change of topic. Joe, you sat down with Lucy Maestrova from the private companies team at Baillie Gifford. Let me guess, did you talk about SpaceX by any chance?
Funnily enough, we did talk about SpaceX, so we'll start with that. Now, Baillie Gifford first invested back, I think, in 2018. It was valued about $35 billion, and it's been quite the journey since then. Lucy talked about how SpaceX has very much been looking for new legs of growth. So it's not just about making launches cheaper anymore. Starlink seems to be actually turning a profit finally. They've also taken over XAI, which is Elon Musk's company behind the Grok chatbot. And they're even exploring using microgravity in space for high value manufacturing. Now, as we probably have all been aware of, there's been talk in the press of a 1.5 trillion IPO valuation. And that would be a pretty extraordinary return for those early investors.
And talking of AI, obviously we've seen a lot of carnage in the software space with Claude kind of coming about. Now, the company that develops Claude is Anthropic. Did you talk about them at all?
We did. I think the key point Lucy made regarding Anthropic was that building a great model and building a great business are two very different things. So the models were impressive. I think nobody's disputing that. But can you actually make money from them? And what caught their eye with Anthropic was Claude Code. That's their coding tool. And that was getting really positive feedback from its business customers, not just about using it, but actively preferring it over rivals products and willing to pay more for it as a result. And that kind of pricing power, I think, is what really made the investment case.
That's interesting. But taking a sort of a step back, why are many of these companies choosing to stay private?
Yeah, I think we've really seen a structural shift here. Amazon went public at around 600 million, Tesla at 2 billion. SpaceX could be worth over $1 trillion, as we've just said, and it's still private. Now, ByteDance, that owns TikTok, today generates around 50 times revenue and profits of Facebook when it listed, as Lucy mentioned. Really the dynamic has fundamentally changed. The value creation that used to play out in public markets is now happening behind closed doors. Going public, frankly, has become more of a burden. Private capital has been fairly plentiful, and the best companies just don't need to list anymore.
Indeed, but fortunately, the investment trust sector is allowed to invest in private companies, and even those other companies you've mentioned, such as ByteDance, is owned by Fidelity China Special Sits. We've got a lot of private equity trusts as well, so some real positives for the investment trust industry. But moving on from private equity to emerging markets, David, you did a video on AWEM. What did you cover off there?
Yes, AWEM. So this is Ashoka White Oak Emerging Markets. Certainly an area of interest for a lot of investors at the moment, given the very strong rally that we've seen in EMs for a while now. Now, we did a bit of a belated results analysis on AWEM just to give a bit of kind of extra insight into the trust, which actually turns 3 years old in May, which is generally a kind of key milestone for investment trusts and funds. Now, leaving that aside, we particularly talked about both India and China, which are obviously the two kind of key pillars of emerging markets there. Now, those two markets had widely differing fortunes in 2025. India in particular is a market that management knows really well, given its deep track record investing there through the likes of Ashoka India Equity, as well as White Oak's open-ended funds. Now, quite obviously, India weighed on AWEM's relative returns through 2025 with IGI India, which is a company that certifies and accredits both natural and lab-grown diamonds, a key detractor to performance, generally, I think, due to tariff-related stuff. That said, management has managed to find plenty of opportunities within the anchor IPO and pre-IPO space, which is a new kind of area for them where they partner with and take a stake in companies before they're looking to kind of come to the stock market.
Now, you mentioned China earlier. How does AWEM think about investing in China?
Yeah, now AWEM's exposure to China is interesting, but also a little bit complicated. It does invest in companies listed in China and Hong Kong, but they also invest indirectly in both of these countries. AWEM is able to invest in companies that are listed on stock markets in developed countries, but that do a large portion of their business in emerging nations. Essentially, this is kind of a play on these companies that are selling a lot of, their luxury products to China. It makes for a bit of differentiation between AWEM and other emerging market trusts, because through AWEM, you get exposure to the likes of LVMH and Richemont. And as I'm speaking, I've actually remembered that I've kind of mentioned this on the podcast before, so I won't dwell too much on that. Suffice it to say that considering China's very impressive performance through 2025, AWEM's underweight China and Hong Kong listed stocks should have been to its detriment. Yet the contribution of these developed market stocks did contribute positively to performance at the same time as giving the trust higher levels of shareholder protection.
Now, Joe, you also sat down with Randy Sandstrom from Sequoia Economic Infrastructure Income, or to give it its rather pithier title, SEQI. What did you talk about?
Yeah, we started off by talking about the core investment case, so the benefit of lending to infrastructure rather than owning it. So SEQI isn't buying bridges, it's not buying wind farms, it's lending to them. And that means sitting higher up the capital structure. So investors are getting exposure to infrastructure cash flows, but with lower risk and a yield of around 9%. So I think SEQI makes a compelling case for investors looking to access private infrastructure debt, but in a listed liquid wrapper.
Now, we usually associate the term active management with equities rather than credit. So what's the case for taking an active approach in this space?
Yeah, infrastructure debt is a relatively inefficient market. So you're dealing with private loans, there's far less competition. You haven't got thousands of lenders pouring over every opportunity the way you do in, say, corporate bonds or listed equities. And that does create real scope for alpha generation. Now, SEQI has a highly experienced management team, a track record of opportunistic investing. So, for example, buying secondary loans at attractive prices in the aftermath of the global financial crisis, and also choosing to step back from overheated sectors.
And where has SEQI been finding the best opportunities?
Yeah, funnily enough, not in data centers, which you might have thought. Despite being an early mover in the space, making their first loan around 10 years ago, they feel that the influx of debt and equity capital in recent years has resulted in tighter spreads and thinner equity cushions. So they're running very much a one-in, one-out policy on data center exposure. But there are opportunities elsewhere within the digitization theme, for example, telecom towers, as well as in energy and renewables. Now, dragging us back to the subject of emerging markets yet again, it's time for Stat of the Month. David, it's your turn this month, so what do you have in store for us?
I feel like we need a new jingle for this little segment, but that can wait, I'm sure. Like you say, Joe, my wheelhouse for this podcast does seem to be emerging markets, and that's where we're staying for this stat. Now, it came from doing a little bit of PA research, actually, and was borrowed with thanks from Mobius Investment Trust, or MMIT. Now, we all know that EMs were, the standout performer of 2025 with a total return from the MSCI EM index of 34.3%. But did you know that the 5 largest stocks within that index accounted for a huge 42% of the index gains? So Taiwan's TSMC, Korea's Samsung and SK Hynix, and China's Tencent and Alibaba really drove EM performance last year. That's almost half the returns.
That is a really interesting data point. But what does it mean, and why did you come across this when researching your own portfolio?
Yeah, well, Joe and I recently wrote an article about the geographic split of our portfolio for our sister website, Expert Investor. And I was a little bit surprised that I didn't have more in emerging markets, if I'm being honest, and maybe a little bit annoyed that I didn't, considering that performance we've just talked about. Despite some of my top performers being the likes of Fidelity Emerging Markets and Pacific Horizon, I wanted to find out whether it was too late to top up a little bit or if there were pockets of value within it. Now, you can read the stat one of two ways, or in fact, both of those ways simultaneously, I guess. You could be the sort of person who says, how can I get exposure to these 5 wonderful companies that are clearly doing so well and have lots of momentum on those sides? I did a bit of a kind of very brief look through the top 10 holdings in investment trust world in emerging markets and Asia. The likes of Templeton, JMGI, Invesco Asia, and Pacific Horizon all kind of stand out for having more than 30% in those 5 stocks alone. Or you could say, which is what I was looking at actually, which trusts have lower exposure to these companies, because it could be that, moving forward, the rest of the MSCI Emerging Markets Index, which don't forget has another 1,191 companies within it, are poised to catch up, and things might broaden out a little bit. Now here I'll highlight 2 that I've been researching. MMIT, of course, is one of them, as well as Scottish Oriental Smaller Companies, which has done less well recently, but has a fantastic long-term track record. Both of these have a mid and small cap bias, but there are others around, the likes of Fidelity Asian Values and Pacific Assets, which have some exposure to these companies, but nowhere near as much as some we've mentioned before. Now, moving on from that, we don't have the final numbers for the most bought trust stocks in February just yet, although we do have a good kind of idea of which companies might be featuring on the list. And one thing that I have seen in particular is some bargain hunting going on. Now, Relex looks like a new entrant, which has been hit by kind of SaaSmageddon, as we'll call it. But investors do seem optimistic that it won't be as disruptive as maybe people think it might do. For now, the investment trust list looks like same old, so we'll try something new in this slot instead, and dig into some interesting stats from AJ Bell about their ISA millionaires. So Joe, do you want to take us through that?
Yeah, some really interesting stats, as you say, from AJ Bell about ISA millionaires on their platform. And I think the first big takeaway was that actually those portfolios were dominated by direct shares and to a lesser extent investment trusts. And what is interesting is that there's relatively little appetite for funds and ETFs, and that suggests these investors are backing their own stock picking instincts. Now, on the shares side, there's no room at the inn for any of the Magnificent Seven, which is perhaps surprising given how much of the gains they've driven in recent years. Instead, it's very much a UK blue chip story. So Shell and BP in energy, Lloyds and HSBC in banking, GSK and AstraZeneca in pharma, all very sensible, mature businesses with reliable dividends.
And I'll just get on the edge of my seat for this one. Can you tell us the most popular trust and see if we can all guess?
Would you like to guess?
I mean, it's going to be Scottish Mortgage.
It is. The most popular, probably the most recognisable. Scottish Mortgage was top of the list. The most popular, probably also the most recognisable. We've spoken about it on previous podcast, so very quick overview only. Unashamedly growth-oriented trust, significant private market exposure, including SpaceX and ByteDance, the company behind the bane of most parents' lives in TikTok. But it's not the only global trust on the list, though. Alliance Witan and JGGI also took spots 2 and 3. Next up was BlackRock World Mining, and investors will certainly be smiling on that one because the stellar gold run has helped BRWM investors more than double their money over the last year. And after that, it's UK equity income all the way, with City of London, Temple Bar and Lord Debenture all making the cut. So proof, if it's needed, that there's plenty of life in the so-called dinosaur of UK equities yet. And on that note, thanks for joining us for the monthly roundup brought to you in association with Schroders. For more investment trust news, insights and updates, please head over to Kepler Trust Intelligence, and we hope to see you again next month. Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorised and regulated by the Financial Conduct Authority.